Welcome to Beacon Wealth Partners Spotlight Series on Fundamental Investment Knowledge, in which we introduce a variety of financial planning topics. This is our third presentation in a series of 3 on understanding investments. I am Jack Fournier.
And I'm Travis Kitson. Please note that this presentation is for information purposes only and is not a solicitation to buy or sell investments. In our first 2 presentations, we talked about why understanding investing is important, the origins of stock, information about the main 2 types of investment classes, and how they behave over time. In this session, we want to discuss the types of investment accounts in Canada and basic concepts in creating an investment strategy. Stocks, bonds, mutual funds, and other investments are held in accounts set up at an investment firm, which is licensed to hold the securities on your behalf. The investments held within this account are kept separate from the operations of the firm. Think of them being held in your own basket. This is very different than how your bank account works. In effect, your deposits at the banks are loans to the bank, and then they make money by lending part of your deposits to other clients in the form of mortgages or loans to buy homes or to operate a business. Like a bank account, you will receive statements about your investments. A major difference is that an investment statement will have a number of sections. One part will be like a bank statement, in that it details money moving in and out of the account, such as deposits and withdrawals, and the income received. Another part will summarize those cash flows and the buys and sells made during the statement period. The main part of the statement will be a snapshot of your holdings, detailing how many you own of each security, its price on that day, and total value for that position, as well as the total account value. The basic type of account is known as a non-registered or cash account. Profits from income or gains on sale of assets are taxable to you. We will discuss taxes in greater detail in another spotlight. To help us achieve financial goals, the Government of Canada created different tax rules that can be applied to an account to help achieve specific objectives, such as retirement or a child's post-secondary education. These special rules shelter earnings within the account from the drag of taxes, which is a powerful tool in achieving your goals. Jack will introduce you to 2 of these.
Tax-free savings accounts, or TFSAs, are a recent innovation, coming into effect in 2009. And don't let the word savings confuse you. TFSAs can hold a wide variety of investments, including stocks and bonds. Contributions to TFSAs are made after tax, so there are no tax savings on your deposits. There is no tax on growth or income within the account, but the real advantage is there's no tax on withdrawals. This makes them a very powerful planning tool. Every Canadian resident over 18 earns contribution room annually. Unused contribution room accumulates, and any withdrawn money is recaptured as contribution room for the next calendar year. These accounts also offer some estate planning assistance. You can name your spouse as a successor holder. Upon your death, the holdings will be moved into their TFSA without affecting their contribution room. You can also name other beneficiaries to the account, where the money will be moved out of the TFSA upon your death and sent directly to them. Registered Retirement Savings Plans, or RRSPs, were created to help us save for retirement. Again, don't let the word savings confuse you, as you want to hold investments that will provide the growth you need to fund your retirement. A significant advantage of these accounts is that when you contribute money into it, you reduce your taxable income. Often this results in a tax refund, which can be applied to other goals. The essential benefit of RRSPs is the deferral of taxes. You contribute during your working years when your income and tax rates are high, and you withdraw during retirement when your tax rate is usually lower. Contribution limits are calculated as 18% of your previous year's income, subject to an annual maximum, and less contributions to a workplace pension. Very importantly, like the TFSA, unused contribution room accumulates. RSPs have many other advantages. For instance, a higher income spouse can set up a plan in the name of the lower income spouse, claim the tax deduction, but have the income and retirement taxable to that spouse, which helps to reduce your future tax rate. RSP accounts have the same beneficiary options as the TFSA, allowing the assets to roll into a spouse's RSP account without taxes. Where the beneficiary is not a spouse, the entire balance of the account is added to your taxable income in the year of death. So here's an idea. Because RRSP contribution accumulates, if you are in a low tax bracket, it often makes sense to defer contributions until you are in a higher tax bracket. Contribute to a TFSA and then move money out tax-free into an RSP where your income is larger, and you will magnify your tax savings. Now Travis will talk about how you draw an income in retirement.
At some point, you will move the investments from your RRSP into a Registered Retirement Income Fund, or a RIF, to set up a recurring withdrawal. The RRSP must be converted to a RIF by the end of the year in which you turn 71. RIFs can hold the same investments as your RRSP, and the withdrawals are taxed the same way as employment income. If you are 65 or older, part of your RIF income can be split with your spouse to help minimize taxes. Financial planning is an important factor in ensuring your income is lower in retirement, enhancing the tax deferral offered by these plans. You must withdraw a minimum percentage annually from the account. The percentage is set up by your age, but you can use the age of your younger spouse to determine those minimums. As a percentage, that minimum rises with age. The frequency of the withdrawals can range from monthly to once a year, depending on your wishes. As we mentioned, these accounts allow you to name a beneficiary. The big difference is the tax treatment when the proceeds do not go to a spouse. When people are retired, it often makes sense to increase the rate they withdraw from their RIF by a modest amount and reinvest into another account, such as their TFSA. You will pay a bit more taxes every year, but this strategy can avoid a very large tax bill upon death of the final spouse. The government also created a number of other types of accounts. For instance, locked-in RRSP and locked-in income funds allow you to hold money contributed into a pension at a former employer. This can give you more control over the pension assets. Additional registered plans also exist to help save for children's post-secondary education and for people with disabilities. For these accounts, like a TFSA, contributions are made after tax, but the government will contribute money to qualified individuals to help achieve their goals. Like RRSPs and RIFs, these accounts defer taxes until money is withdrawn. For education plans, that income is received by the student, who is usually in a low tax bracket. In these three presentations, we have provided an introduction to investments, their behavior, and some tax-advantaged account types. Next, Jack will talk about implementing some of this knowledge.
Creating a successful financial and investment strategy starts with understanding what you are trying to achieve. Is it a short, medium, or long-term goal? Is there a hard deadline, or can you wait? What tax planning opportunities are there, and what types of accounts should you employ? The time horizon and your ability to save for your goal also influences the type of investments you choose. For instance, with longer-term goals, or where your ability to save is limited, investing in equities will become a significant part of the solution. We know that over prolonged periods, investing in equities will provide strong growth, but there will be periods where the market value drops substantially. Euphoria during long bull markets or panic during bear markets can cause us to make investing mistakes. Having an investment strategy in place helps to remove emotions from your process. In any single year, an investment can experience a range of returns from very positive to very negative. Markets experience more up years than down years, and so over time the average rate of return you experience will narrow and stabilize. And now, Travis has another tip.
Start saving early, as your money will have longer to compound, reducing the amount you need to invest to reach your goals. Setting up regular savings purchases, no matter what the markets are doing, will help you benefit from market volatility. As we discussed in a previous video, different investment classes and markets will behave differently over time. Asset allocation is the process of assigning different weights to the asset classes such as equity and fixed income within your portfolio. This diversification of assets tends to reduce the volatility of your portfolio, helping you to maintain your investment strategy. Rebalancing is a process of moving money from components that have grown quickly to those that have lagged. This helps to keep the volatility of the portfolio in line with your comfort level and to also benefit when those other asset classes now excel. While the different components of your portfolio provide diversification, you also need to have diversification within each section of your portfolio. For instance, owning only shares of one Canadian company means you are reliant on how well that company is run and the demand for their product or services. You will want to own shares of companies from different industries, such as healthcare, computer software, manufacturing, and so forth. These companies will behave a little differently from each other. For the fixed income section, diversification would involve owning government and corporate debt, as well as holding bonds with differing times until maturity. Mutual funds and exchange-traded funds are an effective way of creating that diversification. By owning investments that behave differently, some will zig while others zag, reducing the volatility of your portfolio. Jack will talk further about the financial planning considerations.
Planning is not static. Regular reviews are required to determine if there has been a change in circumstances or goals. Sometimes this can entail shifting the asset allocation model. For instance, when people are about to retire, often the proportion of fixed income within the portfolio is increased. Reviews are also conducted on the holdings within each part of the portfolio. If, after a reasonable period, an investment is not behaving as expected, or conditions have changed, a change can be warranted to another investment within the same investment class. Careful consideration should be made before any changes to the portfolio are made to avoid decisions caused by short-term market activity. Understanding how much you need as a down payment on a house or to take a vacation is a simple exercise. When planning for retirement, it becomes more complex. Understanding how much you need at retirement depends on many factors, such as your desired lifestyle, inflation, rates of return, tax rates, and government benefits such as CPP. Other issues like potential health care costs later in life should also be considered. Professional advice is available to help put everything together. Planning is an evolving process with regular reviews to track progress towards your goals. Over time, your personal circumstances and goals can change, driving adjustments to your plan. Until our next Spotlight presentation, this is Jack
And Travis.